All right. Good morning, everybody. Welcome to another educational webinar here from FCI Markets. My name is Justin Paolini, Head of Trader Development, and today we're going to talk about becoming a great execution trader. Before we start, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, just a little bit about me. The only thing that really matters about me is the fact that I spent most of my career on the retail side, and so I've probably made every mistake in the book twice. However, I survived and gradually overcame those issues and finally graduated to the institutional side of the business. And so, having said that, I'm probably in a decent position to be able to help you avoid the issues that I went through during my trading career and to keep you on the path to consistency. I'd also like to remind you that our main objective with these webinars and with all the other education that we put out here at FCI Markets is to give you the tools to be a consistent trader and to help you simplify your trading habits, because we want to expand our trading desk here in the UK, and of course you can also trade remotely. So everything that we do is aimed at giving you quality information to help you achieve these goals and become a professional trader. So today's webinar, Becoming a Great Execution Trader, we are following on from the webinar we held 2 weeks ago, which is still part of the Trader Foundation series. And we talked about some of the main issues that block correct execution of trades. So today we're going to take this a step further, and it'll be a great webinar. We're going to go into detail on how to measure your entry efficiency and on expectancy and whatnot. But we're also going to view some recent examples that a couple of students of mine put forth. So let's dig into this. The premise is always the same. There is a ton of free information, and there are over 10,000 trading books that have been published. So why, oh why, do people still fight trends? And why do they still have issues with their trade execution and trade management and trade identification and all this? Why do they still have issues when everything is probably already out there and there are no real secrets? Last time, we started giving some answers to this. And number one, we said that you need to specialize. Okay, you can't be a jack of all trades. You need to understand that just because you see a move, just because the market moves up or moves down or does something, it doesn't mean there was an actual trade to be had there. If you can't make sense of it, if you don't have a way of identifying situations ahead of time that lead to that kind of move, then you have no business participating, or above all, you have no business fretting over something that happened because you wouldn't have been able to identify it anyway. We all have to trade in ways that make sense to us. Okay, you can't fit a square peg into a round hole. This is something that was drilled into me many years ago. The second thing is, if there's no setup, there's no trade. So, don't jump into your trades. Just because you have a level that the market is negotiating, don't jump into the trade. Wait until you have an actual setup, and don't anticipate it. Don't worry about missing the move. Chances are the market will offer you another setup if the move is genuine, or if the move is not genuine, you won't have your setup anyway. So patience. The third thing was no proper back testing, no record keeping. People just don't know what works for them and what doesn't. They never keep records of their success or the lack of success. Then, jumping the gun. It's connected to this. No setup, no trade. People getting anxious. Always focusing on the money, and trying to trade here and there and everywhere. And then the anxiety due to lack of control over the result of the trade. And this is a big one. People want to control their results. People want to have profitable trades. And unfortunately, until they release this control, until they understand that the only things they can control are how they enter, why they enter, where they enter, and where they exit, they'll have issues, because you really can't control the result, the outcome of any single trade, which shouldn't be an issue if you have backtested and researched your entries, because you know that it's basically random. One trade to the next is a random outcome. It's over a sequence of trades that you actually see your edge develop and you see it being maintained. So we really need to detach ourselves from the outcome of every single trade and wanting, a victory over victory over victory. And then there were the more technical issues, which are, trading too large, and that obviously, reduces your psychological tolerance for drawdowns, because if you're trading too large, obviously you have more anxiety over the result, because your account can't withstand many hits, can it? And then there's also the time of day. So many traders just trade all over the place at any time of day, independently from the session or the situation, before news, during news, after news, in low liquidity environments. They just they trade anyway. And the better thing to do is to filter what times of day, what situations actually assist your trades. So one of the first things I'd like to start with today is that you need to avoid trading just anywhere. I've taken this screenshot from fxssi.com. It shows, it's another, along with MyFXBook, it's another of those sites that shows retail positioning in various forms. And this is just showing the current. I took this snapshot yesterday, so it's a bit different today, but what you'll always notice is that with open positions, traders always aggregate open positions around the current market price. Okay, there's never a situation, I've never seen a situation where you have more open positions above market or below market. Okay, but there's, all the trading activity is going on at the market. Okay, and there's a lesson here. Okay, most traders trade way too frequently, and they trade just anywhere, anytime, and they trade anything. So we need to invert these bad habits. I mean, if we are in an uptrend, for example, wouldn't it be more logical to see open positions from further back, and the odd position being opened at market if somebody's setups are being triggered? And vice versa, if we were in a downtrend, wouldn't it be more logical to see trades opened up above market price, instead of everybody trading at market? I did a study in 2017. I was asked to do a study and some research on retail positioning. And when I watched these metrics day after day after day for about 3 months, I just noticed that it's always the same picture. Traders are always scurrying to get active now. They don't pick their spots. They don't wait. They don't have patience. It's always, they open up their trading terminals and it's like, what can I do now? And, it's a habit we really have to change. We need to be a bit more selective, a bit more patient, pick our spots, and that way we'll start inverting some of these bad habits. The second thing I'd like to talk about today are quality filters. So, quality filters is a nice name to say, study the situations that are best suited for your trading model. Okay, and since we are trying to invert bad habits, let's try to filter trending markets. So everybody knows the euro is in an uptrend, except for, I guess, the past week and a half. Everything is cooled down, but the euro has been in an uptrend for the past month and a half. And we identified some rules previously that can help us wait for proper momentum to be in line with that trend. You can go back and watch the previous webinars if it's not clear, but what I've done here is I just overlaid the daily pivot a simple moving average. This is a 50 moving average, and the weekly opening print. Okay, so we're just going to align these elements, and we're only going to trade when these elements are in alignment. And I've highlighted the boxes where these, where a potential trade situation might have been. And this is the DAX. I'm sorry, this is the DAX, which has also been an uptrend, although it has been choppier recently. And so I've highlighted these situations near the opening of the day. Okay, so we're trying to trade when volume is coming in, when volume is high. We're not trying to trade the doldrums when nobody's around. And we're trading in line with these cues. So, our filter is saying only trade long when we're above the weekly open, when we're above the daily pivot, when we're above the moving average, and the moving average is sloping up. Okay, it's different in this situation here. Okay, you're above all of them, but the moving average is sloping down because we were coming from a few days of negative momentum. So it's not as clear. Okay, it is helping you. These cues will help you train your eyes to see, ease of movement, and that is, that's what you see. I mean, here we have a situation where the 3 price cues flipped us to the downside, and then we have to wait, and price flips us up to the top side again. So it is a matter of waiting, biding your time and waiting. And that's also why instead of trading just one instrument, you can diversify. You can trade multiple instruments using the same approach. So your trade frequency can be a bit higher. And now let's go on to a more recent example. Okay, this example is taken from just yesterday and the day before. And this is dollar CAD. So a lot of traders sort of focus on the support resistance kind of thing, and which makes sense. But unfortunately, as we've seen from retail statistics, it doesn't really help them make profitable trades. So let me show you, I guess this is kind of typical of what happens. And this was a discussion that I had just recently with one of the students that I have. So the student was looking at this recent support zone. Okay, now there are various schools of thought and various ways to define this. Some of them call them demand, some of them will call this supply, some of them will call it support. It doesn't really matter. Go back to the essentials. Okay, go back to the essence of what we're actually looking at. Number one, situations from or zones on the chart from which price sort of accelerates in one direction or the other. They usually do react in some way when price revisits, and the same thing on the downside. Okay, so it's true, paying attention to these zones on your chart is useful if you know how to trade the zones. Okay, and you don't overcomplicate your trading, and you don't overcomplicate your life. So so what was the conversation here? So the trader had seen price create a zone. The zone was tested, and the trader was actually trading here. Okay, this is a 4-hour chart. I'm just showing you. He was actually trading here, and the question is why? Why right here? Okay, the situation here is that sure, price is coming back down towards the zone. However, it's just barely scratching the surface of the zone. And this is one thing I've seen very, very often with people that try to identify these kind of demand supply zones. They get so concentrated on being pip perfect, on identifying the exact level at which price departed, that they sort of miss the forest for the trees. This is a zone. Okay, it really doesn't matter whether price just comes into the zone a little bit or whether it comes in a lot. Actually, the situations that I prefer to see are the situations when price comes down and actually transacts the zone and then generates a reaction. Why? Because it's more difficult and it requires more patience. And that's what I like, because patience is a virtue in trading, and patience is something that we know most retail traders don't exhibit. So anyway, yeah, most of the sort of demand supply kind of entry styles, they all rotate around picking the exact entry spot. Now, if we zoom into a 1 hour chart, I'm sure a lot of you watching will be looking at this exact spot over here, and they're saying that is the point to take the trade, right? And then over here again, that is the point to take the trade, just like the guy I was talking with. However, I think that is a limitation. And I think you need to, well, sure, okay, so if it works for you, fine, continue on, keep calm and carry on. But since I've seen so many traders struggle with this, I'm offering just a different perspective. The actual zone, the actual, exact level may not hold up, and it may act differently to what you expect. So the kind of mindset that I would suggest using is, okay, we've got a zone that has reacted in the past. Now, when price comes back down to visit that zone, I'm going to study based on my research. I'm going to study, because you have to look at these things back in time to see exactly what happens time and time again in the same situation. I'm going to see what kind of setup is presented at the level. Okay, so we're just going to wait to see that the market is reacting in the same zone again and again, because even though it's produced a reaction the first time, that's not a guarantee that there's still going to be traders that are doing the same thing next time around. Okay, sentiment can change, things can change, anything can happen. So, even though it's a decent idea, okay, it is a low risk idea, transacting in these zones here, if you can identify them correctly. But getting all caught up in the pip perfect kind of thing is a detriment to performance. So the whole idea is to simplify this and say, okay, I've got a zone. Let me wait till price comes into the zone. Let me wait till I have a setup, and I'll take my trade. It doesn't matter whether the zone is negotiated just in a shallow manner or in a deep manner. I'm going to wait for my setup anyway. And I'm not going to have any preconceptions, because until, at a fundamental level, until price actually closes through the zone, so until we get a daily close through the zone, the zone is still holding up. It's just a matter of probabilities, and the situation that we're in right now is a bit less favorable because price is aggressively pushed into the zone, and momentum is still to the downside. We still haven't seen any really strong attempts to push prices up. So so this is just another consideration here. So the question is, going back to discussing entries, what do we do? What do you do when price is coming up to your zone? You wait for a setup, for your trigger. Okay, this is the low risk zone. This is where even if you have a day job, you know that you can keep your charts off until price actually reaches this zone. You can set an alert on your phone or whatever. And then price reaches the zone. And what are we waiting for? The trigger and the setup is personal, okay? So what I'm going to ask you right now is, just at a glance, keep things simple. Is there anything that gets you excited or that makes sense to you, between here, here, or even here? Okay, and if there isn't, that's not a problem. It just means that you either have to study your setups better, or we can use different time frames. Let's go on to a 30-minute time frame. Remember, time frames are tools. Okay, when the zone is the low risk area, that's where you're just waiting for a signal if you get one. Okay, it's the low risk area, so you no longer have to worry about about what happens. You know that you have a bias, which is only looking long, and you're only waiting for your triggers. And you can use different time frames to identify the best situation, the situation that makes most sense to you, and that hopefully you have researched and you've studied time and time again in the same kind of situation. Okay, so this is a 30-minute chart. Does anything stand out? Yes or no? And if it doesn't, that's fine. Let's now take this a step further. Okay, let's try and remain simple, but trade smart, okay? The question is, if you are trying to buy off of these lows, who are you playing with? And who are you playing against? The retail positioning usually offers a decent helping hand here, because as we can see, most retail players are long on dollar CAD. Most retail players are trying to do this exact same thing. They're trying to buy, possibly, off of this support. And many other players are probably holding on to longs from further up, okay? But dollar CAD is in a downtrend. So why don't we reverse the situation, okay? And instead of trying to fade prices that are in a trend, even though it is a low risk area, why don't we try and do the opposite? Why don't we try and trade in line with the trend? So if we go back on to that chart, to that 4-hour chart, okay, we can see some very evident departure areas. The first one was here. Price was sent down aggressively, okay, and it produced another one over here, which we still have to transact. We're quite a ways away, so I don't know if that's going to be tested anytime soon. However, earlier in the week, or last week, sorry, price retraced and then was shot down aggressively. So why not use that instead of, or at least as well as, using this zone down here? Why not trade in line with the trend? And if you don't see anything on the 4-hour chart that inspires action and that gives you a favorable risk reward, go on to the 1-hour chart. Is there anything? Okay, don't look here because that's when it was actually generated. So look from here on, here and here. Is there anything evident on the 1-hour chart that attracts your attention? Okay, and if there isn't, is there anything on the 30-minute chart that attracts your attention? Okay, it's as simple as this. Usually price action will help you. Okay, you just have to wait for your triggers at the appropriate zone if you are trading the zone. Okay, and if you don't have an evident trigger, guys, stuff has to be evident. You shouldn't have to look for something. It should be sticking out like a sore thumb right in front of you. And of course it helps to study your setups, to identify, to study, to rehearse, and to know exactly what you're waiting for. But once you're in a low risk zone like this, you just wait for it. And and consider the risk reward of the signal. For example, if we are shorting from way up here, our targets are these lows, 1 and 2. So from wherever we enter, we need to make sure that we have a favorable risk reward. It should be at least 2 to 1, better if it's 3 to 1 or more, between our entry and these levels down here. Sure, anything can happen in between, but you are pre-planning, and ahead of time you have to base your preparation and your ideas on the levels that are evident ahead of time. So ahead of time we knew that this was a key area, this was a key area of support, and that's what we're targeting. So so let's say you see this bearish engulfing and you like this, and you say, okay, well, I'm going to trigger off of here. Okay, well, your stop is above here. That is basically a 35 pip stop, and from 31.90s to, what is this here, about 31.50s, it's about 1-to-1 risk reward. Okay, not great, but viable. So maybe you can enhance your trigger somehow. Maybe you want to get in on a pullback. Okay, the markets often pull back, especially foreign exchange. It's tough that it won't give you a pullback. Okay, so you try and pull back. Can you get in, a little bit higher to get a more favorable risk reward? And if you see anything on the 30-minute chart, your risk reward will be even better because you're anticipating. You might like the situation here, the bearish engulfing. The same kind of setup, bearish engulfing from the level. And your stop this time is half of what it was before. It's only like a 25 pip stop, 20 pip stop maybe. And you have a much more favorable run if price is going to proceed. And this is important. Okay, talking about entry efficiency and becoming a great execution trader, your ex ante risk reward, the risk reward you can identify when you're pulling the trigger, not knowing what's happening afterwards, is one of the main considerations. Okay, you need to keep that in mind. And then the same thing, when price goes back up into the range, you're waiting for your trigger. When does price start to look like it's shooting down? When does price on the 30-minute chart look like it's doing something? You might like this aggressive momentum shift. You might like the break of that momentum shift. You might like the pullback to that. It doesn't really matter what your low risk idea is, as long as it's well rehearsed and as long as you have a favorable risk reward towards your target zone. And in this case, you're also trading in line with the overall flows. You're trading in line with hopefully professionals, and you're trading against most retail traders that are long on dollar Canada. So what are the lessons? Okay, I guess one more thing before I go forward. The discussion I was having with one of my students was about nitty-gritty details, and the areas the student was transacting were down here. So he was obviously looking at this kind of demand kind of zone rationale, the pip perfect kind of thing. And he was trying to trade this long. Now, independently from the result, independently from the fact that the market did produce a bit of an upswing, let's simplify things. Okay, broader picture is we're within a range. Broader picture is that retail traders are long. So we know that our shorts have the upper hand. The other thing is looking for detail instead of waiting for evident things. Okay, in my experience, the more you get tunnel vision, the more you zoom in and you try to make things nice and tight, and you get into the nitty-gritty details, and you try to enhance things, and you try to use multiple indicators or confirmation or whatever, the further you get from excellent execution, from efficient execution. Okay, I'm currently working with an excellent trader, okay, Kevin Conlon. He is head trader at FCI, and he is super relaxed, number one, and he knows exactly what he's waiting for. And his setups, believe me, are extremely simple. And other professional traders I have met are equally simple in their approach, because at the end of the day, it's the low risk idea that will help you. It's not the nitty-gritty detail on your entry that will help you. So you have to ask yourself, if you are looking for the nitty-gritty entry, why does that make sense to you? And can you trade like that consistently? Does it give you an upper hand? Because if your records don't prove that it actually gives you an upper hand, you got to discard it. And if it does give you an upper hand, then it's probably the level. You can really take it down to the essence and say, if that's the level that helps me, instead of going into all the nitty-gritty, why don't I just place an order at the level? What happens there? And then you identify some of the measures we're going to look at soon, and see if you can come out with a profitable trading system over time. And avoid complexity. Strip all those layers of complexity away and get down to the essence, get down to the signal. Simple is best in the markets. Okay, simple really is best. So bottom line is, when you're in trouble with your entries, when they don't make sense, when you can't make sense of anything, when you're having issues, take a step back, simplify and clarify. Go back to the essence. If you find yourself getting into trouble by studying the intraday charts, the 5, the 50-minute, take it back to the daily. Get your signal off of the daily. Just like, for example, 3C analysis, which is, I work with 3C analysis, and we provide institutional technical analysis and directional signals to professional traders. And it's very simple. It's not very simple, but what we produce is to help simplify their decision-making process. So let's say you take a signal from the daily chart, a clear signal from the daily chart that you've rehearsed. That gives you a bias. And then all you're doing is you're looking for a smaller confirmation of this entry. It's simple. You have to simplify. It's never going to be easy, but you need to strive for simplicity. The second thing is that where you enter and why you enter are usually more important than how. Okay, so in the example above, where you enter, and we were talking about a low risk area. Can you define low risk areas in different ways? Or at least can you define it in one simple way and use that consistently? Okay, and why you enter, the why is your trigger. And it's not you forcing something on the market. It's a behavioral trait of the market you have identified and you're using time and time again. Okay, and it's, so it's not complex. It's not the how. Price action will usually tell you, that something interesting is happening if you pay attention. So again, it should be simple. It should stick out like a sore thumb. Then remember to take into account the risk reward of your situation. Don't trade. If we just scroll back up here, let's say that you have a day job and you need to trade off of 4-hour charts, for example. So this pin bar from the lows makes sense because you have all sorts of space from your entry. However, this bearish engulfing, for example, okay, I'm just using examples here. This bearish engulfing is halfway down the range. Okay, the risk reward is not very favorable. So in that case, you might want to wait for either a pullback or another entry and just discard it because the risk reward was not favorable. End of story. You can't complain if the thing goes down anyway because you didn't know what it would do. Okay, you always have to remember and remind yourself that when you're studying, you know what happened. But when you're trading live, you don't know what happens. And so you have to take into you have to prepare your trades based on all the information you have up to the entry. That is what will produce your edge over time if you have the right elements in place. Hindsight is a beast. Hindsight will always lead you into over trading, over reasoning, etc. So the final thing here is remember to take into account your personal objectives and necessities, your time availability, what you want to get out of your trades. Not everybody is wired to trade intraday. Not everybody is wired to scalp. Not everybody is wired for multi-day trading. How are you wired? Have you tested this? Have you tried it on? Okay, because you need to understand what makes sense to you as a trader. So going back now to that sort of quality filter, using the examples we gave previously in the other webinars, we were talking about getting in line with the clear trend and using simple price confirmers like pivots or the weekly bias, a simple moving average slope to help you stay anchored in one direction and not flip from long to short or trade just anywhere. This is the this is the idea. To give you some help is to trade in one direction only, okay, simple, and use one setup on one time frame. So in these examples, we are going to see one direction, and the setup is going to be on the 15-minute chart. We're going to imagine only having the 15-minute chart at our disposal in order to make decisions, and we're going to keep things as simple as possible. Okay, we're basically going to play a pullback, which is evidenced by a CCI. You can use a stochastic, you can use a rate of change, you can use an RSI. It doesn't really matter. All the oscillators do approximately the same job. So we're going to wait till the CCI tells us that the market is either oversold if we're buying or overbought if we're selling. And that just illustrates a retracement. Then we're going to look for an evident candle pattern on the 15-minute chart. And it has to be evident, guys. Don't zoom in to see what you want to see. Zoom out and wait until you see what you want to see. And then we're going to just imagine an entry on the break above or below those candle patterns. And the stop is on the other side. So this is on the DAX, 15 minutes. Okay, we are below the weekly open, below the pivot. The moving average on the hourly was sloping down. Same thing on the 15-minute chart, which is usually a good confirmer. And what we have here is we have the CCI, which is up and overbought. So we're looking short, and we have an inside candle there. Okay, so we're imagining taking this short with a stop above here. Okay, and guys, don't keep your stops 1 pip above the high. Give it a little bit of a buffer. just in case the market probes and tests the high. Okay, just give it a little bit of a buffer. And if you want, if you're looking to hold this, for more than, I'd say, a few candles, consider putting it above the second swing high. So if you're shorting from a swing, consider putting your stop above here. Your risk reward is going to be slightly worse, so consider the risk rewards of placing your stop back here, and obviously consider your objectives. So putting a tighter stop means that you'll have more trades, more stop outs, but the trades that you do win should be much larger. So it's a trade-off. You're going to have a higher win rate, a higher win and also scratch trade rate with a wider stop, but your wins are going to be smaller in proportion. Instead, with the tighter stops, of course, your wins are going to be much larger. So it's a trade-off, like everything. So short there, and you can see that the market did oblige. Other considerations are that this trade happened late in the day, not a great situation on the DAX, but it was profitable anyway as we entered the London morning on the next day. Then for the London morning, there was the retracement. So we're still below the pivot. We're still below the weekly open. And what do we have here? We have our overbought. We have the inside bar, but price doesn't break the lows. Here we have the inside bar, and price does break the low, and it continues. Our stop is above here, and that was a decent trade. That if you held it, would have continued all the way down to here. If you didn't hold it, you scratched it for some reason because of your management methods, you had a different entry, which is an engulfing candle, bearish engulfing from here, approximately the same zone, entry below it, and that gave you a nice momentum ride down to the lows. So again, very simple rules, and the simple rules can work. Vice versa, here we're flipping to the long side, okay, because we're above the weekly open, we're above the pivot, dip on the CCI. We're having the dip. Here is our inside bar. We're buying above the inside bar. Price doesn't do much. It barely holds the lows, okay, and eventually, it does produce other entry signals as well from down here, and then price just goes up. I really don't know what happened afterwards, but maybe we'll see it in the next slide. This is the DAX, so I guess we were further back. But anyway, that's just saying that it doesn't always work, but it doesn't really matter, because as long as you have larger wins than your losses, or your trade management allows you to protect yourself. We're going to talk about trade management more in the next webinar, so don't worry about that. But it doesn't really matter what happens from one trade to the next, because this is only your next trade in your next sequence of 1,000 trades. Or I don't know how many trades you'll take in your career. Depending on your frequency, you might take 40, 50,000 trades in your career. This is just one. And it goes back also to position sizing, I guess, because one trade should never make or break your, one sequence of trades should never make or break a trader. So continuing with the DAX, okay, here we had a bit of confluence, a previous day's high, previous pivot high, prices overcome it. We have our nice dip here on the CCI, and we have an engulfing pattern on the 15-minute chart, and price stumbles a little bit, but eventually off it goes. Here we had a dip, but we were below the pivot, even though we were above the weekly open. Also notice that the 15-minute moving average was no longer sloping up. So it's another, we're looking for self-similarity, in terms of setups. So our setup was to have pivot, weekly open, and moving average in alignment. We have it here. We had it in previous examples. Here we don't really have it, okay, especially down here. And then when price starts to come back above the moving average, we don't have a dip in the CCI. So if anybody is getting upset because they didn't catch this move, well, you didn't have a signal. Relax, you didn't have a signal. Okay? And before you get all fussed up about wanting to catch all these moves, remember that we're trying to simplify our lives, and we're not trying to chase the market and catch every move. My long-term average, and I've traded professionally. I've traded for over 3 years for a group of people, and my average is 3 trades per week, because I always tried to hold my trades for multiple days, but it doesn't always happen. 3 trades per week, and I pass on a lot of opportunities. Does it matter? No, because I know that if I stick to my guns, and if I am selective, and if I'm cautious, then I can work well. And everybody will need to find their own comfort zone. But don't get fussed over missing a move. Here's a better situation. So notice the quality difference between this situation here and this. Okay, notice just how streamlined the moving average is. Notice how price is pulling back in a very shallow manner. It's shallow, though there's a lot of pressure underneath this. And price pulls back. CCI is dipping nicely. Inside bar. Okay, inside bar with a rejection. So the body is inside, rejection from lower prices. You buy atop that, boom, up, and if you hold it, it's a nice trade. You got another trade. Now this is different because this is the Dow, it's not the DAX. The Dow, okay, and this is New York close. So the Dow starts to trade in the European afternoon. So European afternoon, this is more or less where the Dow opened, okay, around here. And this is still into the session, so it's still into the cash session. The DAX instead had already closed, because the DAX is best traded during the London morning, during the European morning session, whereas the Dow, the S&P, the NASDAQ are best traded during the European afternoon session, which is the actual cash session, the session where the pit traders are active, and there's more activities, more liquidity. So this made sense as an entry. A nice dip on your CCI, and you have rejection candles, inside bodies, and away you go. Same thing happened here into the morning, but again, this is the morning session. So, it's better to trade the DAX rather than the Dow during the morning, because this isn't the cash session of the Dow yet. Okay, and although the trade would have been either a slight win or break even, depending on your trade management, it was still a decent opportunity because you are in line with all of those price signals. This is the euro. Okay, now we're looking at the euro. Same thing. We're using the same structure. Okay, to identify our trade situations. Let's go down to the 15-minute. Here you have outside bar, the CCI. Here you have inside bar, pin bar, inside bar, call it what you may. And away you go. Here you don't have anything, so no trade. Okay, notice the CCI never dipped into oversold territory. And if that is one of our requirements, then we need to pass on any trades here. Okay, no setup, no trade. And it doesn't take a zillion trades to make a decent equity curve. Actually, I found exactly the opposite. The less amount of trades you take, the better you filter, the better your results are. So I'm just going to have a sip of tea, and then we'll get on to some technical details on how you can measure your efficiency and how effective you are as an execution trader. Okay, so we're going to talk about 2 measures. One of them is called maximum favorable excursion, MFE. One of them is called maximum adverse excursion, MAE. These are 2 measures that are extremely useful for understanding how good you are at executing your trades and also managing your trades. Because the maximum trade went in your favor before you closed it. And the maximum adverse excursion tells you how far the trade went against you before you closed it. So they tell you about the life of your trades. Okay, what is the lifestyle of your trades? And so, as an example here, we'll actually look at an example soon. The MFE-MAE ratio, so the ratio between how much the trade went in your favor compared to how much it went against you, tells you how efficient your entries are. Why? Because if your trade is efficient, if your entries are good, the trade shouldn't go offside very much. You should see, the favorable excursion outweigh the adverse excursion very, very often. The adverse excursion alone will tell you also whether your stop loss is too tight, okay, so which means your position sizes might be too large and your loss ratio is high, or whether your stop losses are too wide, so your position sizes are small and your win ratio tends to be high. Okay, so for example, if I have a 20 pip stop and my MAE is 10 pips, then I'm obviously working with, I can obviously tighten my stop. I will have less winners, but my winners will be bigger because my position size is larger. And since my stop loss is smaller, the R multiple, okay, the multiple between the favorable excursion and my stop loss will also be higher. So overall, I'm more profitable as a trader. And vice versa. If I'm trying to use a 20 pip stop loss, but my MAE is 30 pips, and I see, and say the market goes against me 30, and then it goes in my favor 100, and I'm just getting stopped out at 20, all I have to do is widen my stop a little bit in order to withstand, the excursion against me, and let that trade go into profit. So the MFE and the MAE tell you a lot about how efficient your entry is. Okay, and you can use the MAE to fine-tune your stop and use the MFE to fine-tune your targets. Because if your trades on average produce, 100 pips, and you're cutting your trades at 50, you know that you are you're getting yourself short. You can do better. So let's check some good examples of MAE, MFE ratios. Okay, so this is taken from MyFX book. If you connect your trading accounts, as I always suggest you do, to MyFX book, it's free, and you can measure via an MT4, MT5 terminal what your MAE, MFE is. So it's a very useful tool. So this is the kind of chart you want to see. Okay, what you want to see is that your MAE, your adverse excursion. Okay, so what we have here is we have the MAE versus trade outcome. Okay, so the average adverse excursion, depending on whether the trade was negative or positive. Okay, and you can see here that this trader in particular is cutting his losses fairly well. You can see that his losses, his losing trades, gradually, I guess generally, stop within 25 pips, whereas his profitable trades are clustered. They're actually clustered around probably 10 to 15 pips, but that can depend on the trade management. But he also has, his outliers between 20 and 40 pips, and some of them that are, that are over 60. So what this shows you, it shows you what things should look like. The profitable trades should have little to no adverse excursion, okay, because your entry is efficient. And so the trades that go in your favor should go in your favor immediately. The trades that don't go in your favor should be cut as soon as possible. And that's what we're seeing here, these clusters. This trader doesn't cut all his trades. You can see that a few of them are, are outliers. This might depend also on the nature of the setup. So this trader might be generally using intraday setups for most of his trades, and he might also have a few multi-day trades where he has a wider stop loss. But this is the kind of chart that you want to see if you're doing things correctly. This is a mean favorable excursion chart, and it's also something that you should want to see. Okay, you can see the favorable excursion on positive trades, okay, is trending up, and it shows that this trader is trying to run his trades. So his trade management is tight. It's probably intraday, but he is trying to run his trades because there's much more variance here on his profitable trades compared to his losses. Okay, the favorable excursion on his losses is very much clustered to those, to minus 10, 15, 20 pips. But this is something you want to see. You want to see, a cluster of poor trades, and you want to see the long tail of the favorable trades as you try to run your profits. And this now is the ratio between MAE and MFE, okay, between winners and losers. So it's showing you, where they are positioned on the relative charts. And it's a great looking chart, okay, because this trader is clearly risking, 25 pips, 20, 25 pips, and he is attempting to run his positions. Okay, so it's a decent setup. What he's trying to do is good, and this kind of chart is what you want to see in the MAE MFE chart. And now let's take a look at some troublesome situations. This trader is obviously not as good at cutting his losses, okay, because his profits are clustered, in between the 0 and the 500 mark. The losses have a long tail and a wide distribution going back, what is this, 1,500 pips? This may be skewed because the trader is also trading gold, or is trading something that's different than foreign exchange, because most of his losses are here. But you see the dispersion. You see this trader has a long tail on his losses, whereas his profits are clustered. They're cut. You never see a profit that's 1,500 pips. His maximum profits are around the 500 pip mark, whereas his losses are 1,500 pips. This trader is doing something wrong. He's not cutting his losses. He's letting his losses run, and he's cutting his profits. Another situation. You can see this trader who has, exceptionally high win rate. But why does he have this wide dispersion in his wins, and why does he have so many winning trades? Simply speaking, he is holding his trades way too long, probably not using a stop loss at all. Okay, because you can see this is the MAE versus MFE. There are some trades, okay, and look at I would also like you to pay attention to the scales. This is the MAE scale, so adverse excursion. This is the bad scale, okay, and it quickly goes down to 600. This is the favorable scale, and it only goes to 275. So you realize that any trade that's below here, that's below the 200 mark, has really been held. I guess I should say any trade that's below here, because 100 to 100, I guess we could put the cutoff at 150, so around this line here. Any trade below here is showing, that he's held it, and it's gone more into loss than it has into profit. Okay, so he's holding his losses. He's running a negative skew strategy. And this is, it's not, I don't care about all the winners. We would never hire a trader like this at FCI, because the magnitude of his losses can be enormous compared to his gains. And finally, another poor example of a trader that is obviously cutting his profits. Okay, you can see this is MFE versus trade outcome. And you can see there's a cap on his profits. There's a cluster. There's a hat on his profits, whereas his losses have a long tail. So once again, they're very different than the better trader before. Okay. Now we're going to talk about expectancy. And I did a quick video on this. You can go and look it up on our YouTube channel. But I did a quick video on this talking about expectancy in practice. Today we're going to look into some other details on it. So, expectancy. Why is it important to be a great execution trader that you monitor your expectancy? Simply because your expectancy is your average win. It's the average profit or loss per trade. Okay, because the mathematical expression is your win percentage times your average win minus your loss percentage times your average loss. Okay, so this is telling you on average what should you expect from each trade. And if you're good with your execution and you have the good MAE, MFE ratios, then your expectancy should hold up over time. And there are two main components to this, okay? Now we're going to dissect it. The first is the actual signal. So the instrument selection, the entry setup, and your exit rule. This is what generates the trading signal, okay? And then there's the money management component, which is the magnitude of your losses and the average loss. Let me just have one more sip of tea. There we go. So when we talk about entries and odds enhancers and filtering quality situations, what we're talking about is selecting the instrument correctly for our trading model, using a well-rehearsed, a well-studied entry, and also using a stop loss that complements the entry, okay? However, the win percentage, okay, and let me take a step back here. Why is all this important? Why doesn't the win percentage depend only on my entry? Because the entry is only the tip of the iceberg. The entry is how you get in. It is not where you get in, why you get in, or what you're trading. Okay, so for example, since we are trying to invert bad habits that we see retail traders make, let's trade a trending instrument. Let's trade in line with that trend. Now let's only filter instruments, let's only filter instruments that are displaying those kind of characteristics. Then let's find a zone, a level, something that gives us confidence, that makes sense, number one, and that gives us confidence that looking for an entry there could make sense. Then we use an entry setup that helps us get in at that level, okay? Those are, and the risk reward, of course, stuff we talked about before. These things help you to filter your situations so that you're not trading everywhere, anywhere, and anything. But really, the most important thing is the exit, because these are the only things under your control. Okay, what happens during the trade is not under your control. And then from the money management perspective, you can't control what is going to happen after you get into the market. It could be a win or a loss, but you can control how big that loss is going to be, and you can control your average loss because it depends on your position sizing. So you can control that. The win percentage depends much more on how we exit, however, okay, on the trade management and how we exit the trade rather than all of this. And if we talk about the stop loss, which was in the first part, okay, it was in the first part, okay, the exit rule. I'm sorry, yeah, it's in the exit, it's in the first part, the signal, our stop loss, because it is a complement to our trade entry. So the stop loss is important, it's essential because it affects 3 out of the 4 variables in the expectancy equation. The stop loss will affect the win percentage because a wider stop loss will mean a higher win rate, but smaller profits. It'll affect the loss percentage because the loss percentage is just 1 minus the win percentage. And it'll affect the average loss, okay? But the stop loss also impacts the position size. So the stop loss affects the money management module as well. What I'd like to say is that having a stop loss, a good stop loss, is an edge. A lot of traders screw up their stop losses. They either keep it too wide or too tight, or they trail it too quickly, or they don't trail it at all. Okay, the stop loss is an edge. Just having a stop loss is an edge because a lot of traders, as we've seen, don't use it. Otherwise, you wouldn't have those traders we saw before still holding long positions on dollar CAD. Okay, so you need to employ a stop loss, and you need that stop loss to complement your entry, and you need to, the stop loss will follow you, and your trade management, as that we'll see in the next webinar, will complement your entry, and they will help you stay in the market or get out of the market when things turn around. But it is the exit. We're talking about stop losses. we could also, transform this into trade management, because the exit, how you exit the trade, how you manage the trade, is much more important than how you enter and what nitty-gritty details you use to enter the trade. That's another reason. So this is another reason why you should avoid complication, avoid getting stuck into complexity and looking for the nitty-gritty details, and instead focus on the things that you can control and that will really impact your bottom line down the road. And your stop loss, your position size, your trade management, and filtering good quality, high odds opportunities for your trades is much, much more important than the actual entry. Okay, so going forward, the expectancy is your average profit and loss over the course of time. So use a rolling calculation. Okay, from a mental perspective, let's go into a bit of mindset here. Okay, so what we talked about before, what we talked about up to now, is the technical aspect of the trade entry and the details of how you maintain an edge. But that's tougher to do in practice than it is, to talk about. Look at this equity curve. This trader has done a tremendous amount of work on himself. Okay, he has gone from a consistently losing situation to a good situation. He is, it can always be better. We can always do a better job, but he's a profitable trader now. However, he has all sorts of trades that are losses, and he has drawdowns. Okay, too many traders sort of think that when they have a setup, they expect to win. And so since they expect to win because they have a setup, they don't really employ a stop loss, or they might widen their stop loss. If the market is retracing and it's going back towards their entry, they'll say, well, I have a setup, so I'm going to win, because the setup is giving me, higher odds or whatever. They just rationalize it. They tell them whatever story they want to hear. But they hold on to the trade instead of cutting it, because the setup is not the same as a winning opportunity. A setup is a situation you've studied, hopefully, that gives you a higher odds occurrence over time. But just like this trader has understood, it doesn't mean that you're going to win every trade, and doesn't mean you're going to win every week. It means that over time, your edge will materialize. And you have some really nice winning streaks as well, but you also have to withstand these drawdowns. Okay, and most starting out traders, most average traders, most retail traders, they hate this. And this is when they go looking for other systems. This is when they go system hopping and they go looking for other things. And when simply they might have been doing the right thing, they're just in a drawdown. The market is just not responding. Okay, and it happens to the best of us. I went through a horrible drawdown in 2019 because volatility collapsed. So, you have to understand that trading is about resilience through these drawdowns. Okay, you're not going to have a 45-degree equity curve. This kind of equity curve here is produced by traders that cannot withstand losses. It's produced by traders that want to be right. It's produced by traders that shouldn't be trading, basically. Look at what these guys do. This is a random sample from my FX book, because most systems in there, just like most systems that you'll find on the web, are doing exactly the same thing. They're taking minuscule profits with high leverage, okay? And of course, they have a disaster stop loss, which almost never gets hit, but when it does, it is horrible, okay? And then what they do is they martingale once they have the stop loss, since they know that on average, they have win after win after win after win. The time they have a stop, they know that after that, they're probably going to have a win. And so they leverage their next trade and they make back that loss. But this thing is just, it's against everything the good trading is about. This kind of system it hinges on your win rate. which is the exact opposite of what you should be doing. Okay, and this and scalping for 2-3 pips with high leverage, holding on to losses. I mean, you really don't know how bad the situation can be, and you see these massive swings in your equity, and you have to work and work and work and work. And actually, what people do is they martingale their way up, so that they make back that whole loss in one trade. But what if that goes wrong? And now you're really deep into the red zone. You're probably eaten up most of your profits. And if your next trade isn't a winner, you're probably going to blow your account. So once again, it is. I really don't understand how these systems can withstand so many years of trading without blowing up. But it's just detrimental. It's not the kind of trading we want, because losses are unlimited. So going back to an example from one of the traders, one of my students that I've been talking to recently, this is typical of intraday situations. Okay, intraday trading, higher frequency of trades. This is what you should expect. Okay, expect a battle. The trader had a setup. It's not important what the setup was right now. What is important here is that we're discerning between setups and wins or trade outcomes. Okay, we have to discern between the two. Setup. The trader is in the market. The market reverses, the trader's out. Basically break even. The market did something that stimulated the trader. He's in again and out for a small loss. The trader had another setup. He's in, and this one was a runner, and he held it all the way down here. So at the end of the day, he's profitable. This is the day in, day out regime for intraday traders. And for slightly longer term traders, for swing, it could be what happens during a typical week. But the profit and loss, you get a break even, you get a stop, you get a nice win, then you get another stop, you get a break even, then you get a win, another win, a stop, a break even. It's a fight. You take some, you have to take some, you have to, just like I guess in boxing, you take a few hits, you got to still stand on your feet, and you give some back, and the ones that you give should be harder and stronger. Okay, so it's a battle. Don't think that a setup means that you're going to have a profitable trade. Your setup is what gives you the edge over time, but the distribution of your wins and losses is random. You have to understand that. You have to detach yourself from the outcome of every single trade, and that's where the trade management really helps too. To conclude this whole thing, which I hope was entertaining and instructive, remember that ups and downs in your equity curve are the norm. They're not the exception. Okay, you need to remain steadfast with your model and have that process. Follow your process that is as systematic as possible for the trade idea generation. And we've gone through some ideas in the previous webinars. Execution. Examples in the previous webinar and this one. Trade management, which is coming up, and position sizing. You need to have a process for each one of these components of your trading system. Okay, and then you have to take the ideas that we give you, study them, mold them with your own, personalize your process, because we need to give you the power to make good trading decisions. I don't want you leaning on me or leaning on any of us here at FCI. I want you standing on your own 2 feet. We're trying to give you good suggestions, but at the end of the day, you need to take accountability for your trade decisions. And if we say something that just doesn't mold with what you're doing, fine. Find your own way, but make it a process, and get out of the mindset that you have to be right or want to be right, because some of the most profitable traders I've seen have like a 35 to 40% hit rate. Okay, so it's not about being right. It's about how much you make and holding on to your winners those times that the market does prove you right. And it's about cutting your losses as soon as possible when the market isn't proving you right. So coming up in 2 weeks, we're going to be talking about trade management. Don't miss it. It's essential. It's the other ingredient that helps you ride your winners and cut your losses. And in the meantime, if you need help or you need guidance, there are a few things you can do. Subscribe to a thought leadership blog. In the bottom right-hand corner, click on the box, leave your email, and that way you can receive our morning calls, weekly calls, and any videos that we do, anything in your inbox directly. Follow us on Twitter for frequent updates. And if you're really serious about becoming a professional trader, then consider coming to our Professional Trader Academy. If you don't have a track record, if you don't have a system, then just come to the Academy, because we provide you with that. And you also have the opportunity to get a fully funded account after graduating from the Academy. So, it really is everything we do, like I said at the beginning, everything we do is just to help you come aboard and become a professional trader and make that transition from the retail space to the professional space. Finally, we're always happy to hear from you. If you have any questions at all, give us a call or send us an email to client.support@fci-markets.co.uk. Or if you're located in the UK, just come and visit us. We're happy to hear from you. We're happy to help our clients take their trading to the next level. So I'm going to open up the stage for some questions. And if there aren't any, then I will just wish you all the best and thank you for coming. It seems like I've given participants a lot of information. No questions right now. All right. Well, in that case, I'm going to wish you all the best, and I look forward to seeing you in 2 weeks for our next webinar on trade management. This is Justin Paolini for FCI Markets. Over and out.